It's been almost 10 years to the day since the collapse of Lehman Brothers, which subsequently led to the worst financial crisis in almost a century. Now, with markets near record levels and an economy that continues to show strength, has enough been done to avoid another crisis like that? In a CNBC exclusive, I'm joined by Terry Duffy, CME Group Chairman and CEO. Very good afternoon to you, Terry. Thanks for joining us.
Thank you, Wilfred. Appreciate it.
Take us back to that day, the day when Lehman went under. I mean, how bad did you fear things could get in the coming days and weeks?
You know what? I had no clue how bad things could come in the coming days or weeks, Wilfred. I do remember very vividly, you know, we were down in Florida. We had our first annual conference down there, and I'm sitting with Paul Volcker at the time. And we had a huge lineup for our first ever conference, and people were dropping like flies, obviously, that day and canceling. But the interesting part was we had, you know, the former chairman of the Federal Reserve there to talk to our clients about what he thought what the Lehman collapse meant, because it literally happened on the day he was speaking. And then I had the former Prime Minister of Great Britain, Tony Blair, there as our keynote speaker. So he went from talking politics to talking business. So it was quite a fascinating day, the day that Lehman filed for bankruptcy, and the days and weeks after. Obviously, we all saw the carnage that happened throughout that following 12 to 18 months.
And the thing that, of course, followed the carnage was significant regulation. Dodd-Frank, the sort of most significant part of that. Do you think all of that regulation was justified?
You know what, Wilfred? I was one of the ones I testified probably 10 to 15 times between the House and the Senate on Dodd-Frank throughout the years about what the regulation should look like or not. And, you know, it's amazing. I said that, you know, unfortunately, if we didn't have new regulation, we were heading for the Stone Age. So we had to have something. Unfortunately, when you get regulation, major pieces, which we've only had 4 or 5 in the last 15 years of major regulation, not appropriation bills, that you're always going to take the needle and move it too far in one direction. I think that's exactly what we did with Dodd-Frank. It doesn't make it right, wrong, or indifferent, and I think eventually it'll come back to the middle and it'll be healthy. And, you know, the United States was the leader in doing regulation. We're looking at the uncertainty still in Europe, that it's not fully done the EMIR 2.0 or the MiFID 2 regulation, but, you know, Dodd-Frank is behind the U.S. markets, and it's one of the reasons that we're seeing the U.S. grow, because we have the rules of the road in place in the United States for investors, and they know what they are. So if anything, the rule should, you know, tilt back more towards the center versus more to the extremes.
Yeah, and the U.S. banks certainly stronger today than the European banks. Terry, what did all that regulation and the reaction in investors' minds after the crisis mean for you at CME Group? I mean, the amount of futures, derivatives, options, what did it make to the amount that those were traded and CME's bottom line?
You know what, it's really interesting you bring that up, Wilfred. I was looking at some statistics from 2008 just the other day, and if you look at CME, we roughly had 63 million contracts of open interest or positions open on our books. Now, the value or the notional value of that 63 million contracts is about $10 trillion in 2008. Today, Wilfred, we have roughly 125 million contracts open with a notional value of just north of $21 trillion of value sitting on the books of CME. So what does it mean for us when you look at the growth of people needing to manage the risk because of what happened in 2008 to where we're at today? So even though interest rates are at historic lows, we have equities at historic highs, you still need to manage and mitigate your risk, and people are doing that each and every day since the crisis.
That said, if you look at the markets more broadly, Terry, as you say, equities near record highs and the levels of volatility, whether we're using the VIX as the measure or other measures, still pretty low. Does that make you wary that we are approaching, whether or not another big crisis, a big pullback?
You know, I won't predict whether there's going to be a crisis or not. I will look at some of the fundamental factors. You know, when you look at some of the debt that we have outstanding today, obviously the housing debt's the biggest, but the two ones that I look at that concern me a little bit are credit card debt and student loan debt, both about $1.3 trillion respectively, 1.4 for credit card debt. Those are huge numbers of debt, one which is not forgiven under the bankruptcy laws, as you know. You know, the the future participants in the marketplace, the younger people that are coming in to buy homes, assume debt, assume liabilities, these are the people that are a little bit more risk adverse as we go. And you know as well as I do, if any economy is going to grow, you have to introduce some kind of risk into it. You cannot grow in a riskless society. It just doesn't work. So, you know, I am a little concerned about those two factors, and I'm a little concerned about the spending power of the young people going forward for the next 10 to 20 years.
Terry, I just want to come back. Final question. You mentioned that the pendulum of regulation tends to go too far. Yeah. In some of our past discussions and some of your past comments, you mentioned the Volcker rule. If that were to be removed, a lot of the banks suggest that they wouldn't go back to prop trading, that all it would do would reduce their costs in terms of showing the regulators whether they're market making or not. What's your take on that? If the Volcker rule went away, do you think, in fact, the truth would be a lot more risk-taking, a lot more prop trading, or do you think it would just be a reduction in regulatory burden and cost, as some people argue?
I think it's Wilfred, it's a great question, and I think it's a combination of both. I think the banks would go back to proprietary trading, and I think they should be able to proprietary trade. There's no reason why they shouldn't, as long as it's under, you know, a limit of some kind and not just reckless type trading. So I do believe that, you know, I was a proponent of not invoking the Volcker Act. You know, here's kind of how crazy the Volcker Act is. The Volcker Act allows banks to proprietary trade in U.S. debt on the cash side, but 105 to 108% of the notional value of the U.S. debt market is traded at the CME, and they are not allowed to trade that market. So to me, the Volcker rule needs to be looked at, revised in some way, shape, or form. I think the banks will take responsibility, proprietary trade, but you know, they need to make money as well. Otherwise, the cost of their services are going to get passed off to the consumers, and that's just the way it works. So I think as long as there's some kind of boundaries in there for the banks, I think it's healthy for the marketplace. The more participants, always the better.